In the silent depths of the cryptocurrency market, where numbers move faster than emotions and billions shift without warning, a single action can send shockwaves across the world. This is the story of one such moment, a moment that revealed the power of a Bitcoin whale worth $11 billion, and a gamble that could redefine the short-term future of crypto. Late at night, while most of the world was asleep, blockchain trackers noticed something unusual. Wallet movements began to light up the chain. At first it looked like routine activity, but within minutes analysts realized this was no ordinary trade. According to data reported by Luke Kanchan, one of the largest crypto whales in existence had just made a decisive move. This whale, holding a net worth estimated at $11 billion, liquidated $330 million worth of Ethereum for many investors. Selling ETH at such a scale would signal fear or retreat, but this was not a retreat. It was a repositioning, and what followed stunned the market. Immediately after the liquidation, the whale opened 3 massive leveraged long positions, totaling $748 million across Bitcoin, Ethereum, and Solana. This was not a hedge. This was a statement. To understand why this move matters, we must first understand what a whale truly represents in crypto. A whale is not just a wealthy trader. A whale is liquidity. A whale is influence. When a trader of this magnitude moves, exchanges feel it, algorithms react to it, and retail investors follow it, often without fully understanding the risk. Leveraged longs are especially dangerous weapons. They magnify gains, but they also magnify losses. At this scale, even a small market reversal could trigger liquidations worth hundreds of millions of dollars. So why would an $11 billion whale take such a risk? The answer lies in timing. Market sentiment had been fragile. Bitcoin was hovering at critical levels. Ethereum had shown weakness, and altcoins were struggling to find momentum. Fear and uncertainty were dominating social media. Many retail traders were positioned short, betting on further downside. And then this whale went long. By opening leveraged long positions on Bitcoin, the whale was signaling confidence in the market leader. Bitcoin remains the backbone of the entire crypto ecosystem. When Bitcoin rises, confidence follows. When whales bet on Bitcoin, they are often betting not just on price but on psychology. The second position, Ethereum, was even more intriguing. The whale had just sold $330 million in ETH, only to re-enter via leverage. This suggests a strategic reset rather than abandonment. Spot ETH was liquidated, but leverage was used to maintain exposure with greater capital efficiency. In simple terms, the whale freed up capital, then used leverage to amplify the upside. The third position was the boldest of all. Solana. Solana represents speed, risk, and speculation. It is loved by developers and traders, but criticized for outages and centralization concerns. By opening a leveraged long on Solana, the whale was betting on high volatility and potentially explosive gains. This three-pronged bet tells a story of calculated aggression. But whales do not act blindly. Behind every move is data, models, and probability. On-chain metrics were showing signs of accumulation. Exchange reserves were declining. Long-term holders were not selling. Funding rates suggested that short positions were overcrowded. In such an environment, a sudden upward move could trigger a short squeeze, forcing short sellers to buy back at higher prices, pushing the market even further up. A whale entering leveraged longs at this moment could act as the spark, and that is where fear shifts sides. Retail traders often believe whales know something they don't. Whether that belief is true or not, it becomes reality in price action. The moment this data went public on X, sentiment began to change. Traders started closing shorts. Others opened longs hoping to ride the wave. But this is where the documentary must slow down, because this is not a fairy tale. Leverage is unforgiving. If Bitcoin drops sharply, even briefly, liquidation engines do not care about reputation or net worth. Positions are closed automatically. A move of just a few percent could wipe out tens or hundreds of millions. So why risk it? Some believe this whale is positioning ahead of a macro event, possibly ETF flows, institutional buying, or upcoming policy shifts. Others believe it is a liquidity hunt, forcing the market upward to liquidate shorts, then exiting at a profit. There is also another possibility. This whale may be shaping the market itself. When capital is large enough, price becomes partially reactive rather than organic. Liquidity pools shift, order books thin. Smaller traders become passengers rather than drivers. Yet history reminds us of one truth: even whales can bleed. Crypto has seen billion-dollar traders humbled before. No position is immune to black swan events. News, regulations, hacks, or macroeconomic shocks can erase confidence in minutes. This is why this moment matters. It is not just about $748 million. It is about conviction versus risk. It is about intelligence versus arrogance. It is about whether experience can outplay chaos. As of now, the positions remain open. The market watches. Analysts refresh charts. Social media speculates endlessly. Some call it bullish, others call it reckless. But one thing is certain: this whale has drawn a line in the sand. If the market rises, this move will be remembered as a masterstroke, a perfectly timed bet that turned fear into fuel. If the market falls, it will become a cautionary tale about leverage, even at the highest level. In crypto, legends are not written by size alone, they are written by survival. And as the charts continue to move, the world waits to see whether this $11 billion whale swims forward into profit or into the deepest liquidation the market has ever seen. This is not financial advice. This is not speculation. This is the anatomy of a gamble happening in real time, and the outcome is yet to be decided.